Good evening and welcome to On the Record. I'm your host, Adam Jasser. Europe's most powerful politician, European Commission President Ursula von der Leyen, has finally assembled her 26-member executive team. Once confirmed by the European Parliament, the new commissioners will seek to implement her ambitious agenda to revive the EU economy. The blueprint for this has been laid out in a 400-page report by Mario Draghi, a former Italian Prime Minister. On the record, many politicians and analysts hailed the report. But off the record, the same people admit that implementing it is another matter.
Just after the lineup of the new executive body was presented to the European Parliament, Mario Draghi warned deputies in a speech that Europe was badly falling behind the United States and China due to lagging digital innovation, stale business models, a shrinking workforce, and dispersed, uncoordinated defense spending.
It is that over time, we will inexorably become less prosperous, less equal, less secure, and as a result, less free to choose our destiny.
The people who will be in charge addressing the challenge will be Ursula von der Leyen and her select team of commissioners holding key economic portfolios. Those are France's Stéphane Séjourné, a close ally of French President Emmanuel Macron, who will be responsible for the bloc's industrial policy. Italy's Raffaella Tenconi of the right-wing Brothers of Italy party, who as executive vice president for cohesion policy will help poorer regions catch up with the rest of the bloc. And Spanish socialist Teresa Ribera, who will hold the powerful competition portfolio and look after the future of the Green Deal. A crucial budget portfolio will also be held by Poland's Piotr Serafin, a career civil servant, Brussels insider and Polish Prime Minister Donald Tusk's ally, who will report directly to von der Leyen, consolidating her control over the Commission.
To discuss this report, to discuss the broader European context, I'm joined today here in the studio by Robert Sochacki, Chief Executive of Pekao S.A., the second largest Polish bank, and remotely by Raffaella Tenconi, an economist who is a frequent guest on our program. Both of you, welcome to the show.
Thank you. I'm glad to be here with you.
I'm glad too. But I have a technical question to Mr. Chairman first. Has your bank ever produced an economic report which is 500 pages long and needs 70 pages to summarize?
Executive summary. I doubt that. It's a massive work that was done by Mr. Draghi. So I don't think that we are eager to compete on this with Professor Draghi.
So were you able to find anything in that report that was of particular interest to you?
Well, the whole report is interesting, at least as we
but
look at it.
In diplomatic speak, if you say something is interesting, it means, I find it hard to understand.
No, honestly, I think it addresses all the major issues that Europe is facing, and we see it also in our local, let's say, market. We see problems that Mr. Draghi is outlining also in Poland, and we are trying to address it. We see initiatives that are aiming at increasing innovation, at increasing security, at increasing productivity. We try to improve the green energy mix to more green.
But these are the issues, Europe has been talking about these issues for ages. So maybe I can switch to Raffaella now and say that, and ask you, I'm not going to ask you if you read the entire thing, but I'm pretty sure that you actually know the most points that are really important and what's more, which can be implemented in the EU. So can you give us a brief summary on that?
So, first of all, I have read the report, and
amazing.
No, not so amazing. What I would say is, what is amazing is that it's formatted in a way that it gives clear next steps. But what should not, the substance of it should not be a surprise, and should not be a surprise certainly to a commission that is so rich in technical staff. So where I'm trying to get to is the whole report is implementable, I would say, but the key question is not which part is not implementable or not. The key question is how long it's going to take to implement, because ideally this should be fast deployment, but in reality, it will take a very, very, very long time, both because of regulatory and political issues, but most importantly is Europe. So that means the Commission, the Parliament, the ECB, and all of the other decision makers that are involved are not coherently yet embracing the message of the report.
So we're talking politics, and I'd like to return to that. But maybe I could ask you first, what do you find most relevant for Central and Eastern Europe and Poland in that report?
Well, no question that security matters are important for Poland, especially at this time. And we see that in this area, Poland is trying to improve a lot, and big investments are done. So we expect.
You're talking about defense.
Defense, yes. Mm-hmm. So security in the sense of yes.
Hard
defense.
security.
Hard security, yes.
Mm-hmm.
So we see that in this area there are big plans and big money coming, and big appetite for both production and buying from abroad. So I think that this is the very important part of what Mr. Draghi identifies, and it is very much relevant to Poland. And also in the energy mix. Poland originally comes from the not so clean energy. And again, there are initiatives, both offshore, onshore wind farms or solar panels, and we'll see also the investments in nuclear energy. So Poland is also
see a
working.
promise in this.
Definitely.
The bottom line is that you see advantages for Poland and the region from if the report is implemented, I presume.
Yes, definitely.
I wanted to breach another subject, which is that some attention in the report is devoted to China and the role of Chinese investment in Europe. And in this context, Central Europe is mentioned by Draghi, because he's mentioning electric vehicles as an example of Chinese expansion and causing huge problems for the European car industry. And he mentions Central Europe specifically, saying that governments in the region should be careful about just vetting these investments. And, the implication is that they should really not allow them. But the European car industry is divided on this. And this is, this shows already in some of the comments about the Draghi report. Raffaella, what's your take on this?
I think realistically, complete decoupling from China is unviable, and I would say probably also undesirable. So yes, I think vetting of all of the investments is important. Transparency of these investments and all contracts, I think, is definitely desirable. But I wouldn't necessarily say that there is an implicit political message or an economic interest in reducing Chinese investment in Central Europe or in Europe. I mean, the Germans, the car industry, but I mean, there are many other industries that would not realistically function if you were to chop that link.
What's the Polish perspective on this?
Well, we have a lot to do in this area also. I think generally the demand for electric vehicles will be growing.
But this year it's falling.
Yes. Yes, but I think Poland is not producing their own cars. Probably we will welcome investments in this area.
Even from China?
This is from economic point of view, China is very much advanced in production of electric vehicles. Of course, as any cooperation with China, it has probably a political dimension also, but I'm not an expert in the political dimension of this kind of decisions.
But would you agree that some scrutiny of these investments are required, or do you think it doesn't really matter? Capital, capital doesn't have nationality, so to speak.
Capital does have nationality, but scrutiny in every investment is desirable. And I think also in this, maybe especially in this, but I think we should also look at how Poland can benefit from not just buying the electric vehicles from abroad, but how our industry can benefit from it, and as it benefited from being also as first assembler, then to a certain extent producer of the cars in for Western Europe. So I think
before I switch back to Raffaella, I just wanted to ask you one more thing about the Draghi report, which is, we just discovered that of hundreds of companies and entities and business groups that Draghi consulted on this report, there was only one entity from Central and Eastern Europe. How would you react to that?
Well, I haven't prepared the way the report should be conducted, or whom the Mr.
But isn't
Draghi
that
should
striking to you?
Well, it is in a sense that Central and Eastern Europe is a big part of Europe, and the interest of this part of Europe must be taken into account. And I think either with the representatives of the region or without, we should be sure that the interest of this part of Europe will be taken into account in realizing or implementing the strategy. So I think, well, the fact is a fact, but what we do with it is a different story.
Okay, let's now talk a little about the financial side, because Draghi mentions the question of the single market or single capital market, which is the financial sector in Europe as such. And again, this is something quite amazing, because we know that European banks have up to 10 trillion of euros in deposits. And at the same time, Mr. Draghi is saying Europe needs to borrow money in the financial markets. So to me, I'm not an expert, but to me it sounds like a massive failure of the European financial system. Raffaella, what do you think? That there's no transmission between these deposits, this huge savings, and the needs of the economy?
Yes, and I think, allow me to raise 2 points. One is partly related to what you were asking before, Adam. I think you pointed out that there is only one reference to a Central European think tank in the report. And I would say that looks bad, but to some extent, I think the report was meant to be a stronger message to core Eurozone countries, because those are the countries that are failing to understand the urgency of starting the investment cycle. Central Europe is very well on board to understand. In fact, the risk is the frustration between these two power groups. So I would say don't take too much offense. I think it was mostly directed to those that are not doing
Raffaella, I already feel better.
And on the question of the funding, yes, unfortunately, European banks have discovered that it's somewhat easier to manage savings than to actually lend. But that will come with lower interest rates. And to some extent, what I hinted in my first answer, the investment cycle can only come if there is demand and if the funding costs are appropriate. There is still a lack of coordination between how the ECB perceives monetary policy and how the Commission wants to implement the investment cycle.
But isn't the problem?
But on top of that, sorry.
But isn't that problem somewhere else? And maybe we can ask Mr. Chairman about this. It's European banks are small in comparison with U.S. banks, and the entire financial ecosystem in Europe is just much smaller, much less sophisticated. And isn't that part of the problem? And Pekao SA, your market cap is what, 10 billion euros, more or less, right? Santander is 60. The American banks are gigantic compared to that. And isn't that part of the problem, this fragmentation and the fact that there is no single financial market in Europe, Raffaella?
I think definitely it's a huge problem that the capital market is not sufficiently united. It's too fragmented among too many stock exchange. And most importantly, that retail investment platforms are not sophisticated enough. And that means that Europe is not attracting enough global savings the way the American markets are. And Europeans do not have enough, first of all, knowledge, but also possibilities to nourish the transition. So you have two problems. The banks and the capital market union both need to evolve to fund the project.
Mr. Chairman, is that something that is close to your heart, the fragmentation, the lack of sort of transmission between savings in Europe and then this capital being available to businesses?
Well, I think Europe is more kind of debt-oriented than US. US is more
you
equity.
need to explain that to
that means
government bonds.
Government bonds.
Right. Investing
bonds
in government.
In generally.
Right.
Bonds, more safe types of investment. And this is a kind of fact for the whole Europe.
Cultural fact?
Maybe cultural fact. Well, even in movies, in the US, everyone has savings invested on the stock exchange. In Europe is slightly different, and the willingness to invest in more risky assets is lower. The same is in Poland. We see it. We see how much money goes to government bonds, inflation-linked bonds lately. How much money is invested in or just staying on the bank account. So
you're basically saying that this is more people's preferences rather than the weakness of the financial sector, small size of banks and all of that?
Well, this is part of the problem. And the second is, I think, is also incentives that people have. So I'm pretty sure that by incentives you can direct money to certain areas. And I'm not sure if really the priority for European financial market is directing the money to the equity market rather than bond market.
But is bank consolidation, Raffaella, something that has been talked about in Europe for many, many years? Is this a precondition to make this Draghi project fly? And is this something in the report? Because he's actually suggesting to allow European banks and companies to gain scale and compete with the US and China. So is bank consolidation something that we should watch?
I wouldn't say it's necessarily a precondition, but it's probably desirable for technical reasons that we live today in a world where there are some asset managers that have trillions and trillions of dollars under management, and therefore the size of the liquidity of the assets that they hold does matter very much. The more small companies you have, the least natural buyers you have. So I think banks, it's an obvious, just like energy companies, some degree of consolidation would help. But I would say that the real key ingredient and the key leap forward in terms of quality that we need to do is to really support first of all, greater access to, not just to bonds. Households buy bonds because historically it made sense. CPI linkers, for example, in Poland makes enormous sense.
So you mean the bonds which are linked to inflation, right?
Yes, exactly. It's an obvious, simple choice for a household. It's great that it's out there. But of course, in the evolution of society, we also must allow people to understand, be comfortable, and invest in equities.
Okay. Well, I'm still not entirely convinced, but let's leave it at that, and let's move to the next thing, which is implementation. That von der Leyen is the big boss and that she likes Draghi's report is beyond doubt. But how about the rest of her team? There seem to be two contradictory opinions about who will be running the show with her. The French, Italian and Spanish commissioners who favor more EU intervention, or the Germans and the Dutch who refuse to endorse joint EU borrowing to finance Mr. Draghi's plans. See how this plays out in the opposing takes of the Financial Times and Politico, two of the most astute media outlets covering the EU.
Ursula von der Leyen has given Brussels' biggest industrial and economic jobs to more interventionist countries, vowing to boost the EU's lagging competitiveness. The European Commission President gave the most prominent growth-related posts in her team on Tuesday to Spain, Italy and France, which have called for more joint spending, looser budget deficit rules and a bigger role for industrial policy. Germany retains quiet grip on Europe's finances. Von der Leyen's loyalists hail from countries that don't like splashing the cash. While others may have posher titles, those frugal hands still hold the power. Appearances can be deceiving. While the European Commission's reorganization this week made it seem as if big spending governments from the south had seized control, in reality Germany and co retain an iron grip.
So, is it team invest more or is it team remain frugal, Raffaella?
I think near term, the biggest problem we have, and I stress problem, is Germany. Not just because of its current stance on joint borrowing, but because the debt break legislation in the German constitution severely constrains their own ability to take on borrowing. And I think this is a very serious barrier to implementing the Draghi report. And the problem is that without investment in these technologies and this transition, we will pay an enormous price in terms of productivity, inflation, and wealth.
Right. So the final question to you, maybe we can just step back a little bit from economics and finance and go back to culture that we discussed earlier. The whole purpose of this report was to say, if we don't change, we're going to fall behind the Americans and the Chinese. But again, some commentators point out that there are huge cultural differences, but also political differences, such as, for example, the United States is a single nation state. It has a federal government, so the Americans didn't need a 400-page report to launch the Inflation Reduction Act, which is a law about investing in infrastructure, manufacturing in America. Biden just did it with Congress quickly, and they see the first results quickly. So as Raffaella mentioned before, it can take time for Europe to implement some of these plans. So where does it leave us? Are we permanently behind America?
Well, the implementation of the, let's say, major points of the report is the matter of how determined we are to implement it. So
do you detect this determination across Europe to implement it?
We will see. We just saw the report. I think we all see that there are problems like that. We see these problems on the member states level. We see it in Poland. We see it in every country, basically. We see challenges with implementing it. But I think if we are determined enough, and we should be, the question is when, maybe, but not if. So I think there will be will to do it, and it already started on the country level, but maybe it's time to really also start it on the European Union level in the more kind of coordinated way that Draghi is pointing.
Right. So Raffaella, final word. Do you believe the EU has a role to play in this, or is it more on the nation states to get their act together, as you said, mostly in the West?
I think the EU does set the plan, but ultimately what I expect is that we will inevitably fail several times until we really get to the point that implementation is smooth. And so what I mean by that is I expect countries to resist the implementation. It will fuel discontent because ultimately Europeans want growth and want a better future. It will feed into a second wave of political response, and we'll carry on like this for 2 or 3 times at least before we really get going.
So without a crisis, there is no reform?
Yes.
Okay. Raffaella, thank you very much, Mr. Chairman. Thank you. Thank you for joining us. And that's it in today's On the Record. Thank you all for watching, and goodbye.